Good evening, ladies and gentlemen. I welcome you all to the Q4 and FY23 post-earnings conference call of Virtuoso Optoelectonics Ltd. Today from the management, we have with us Mr. Sukrit Bharti, Managing Director, and Sajid Sheikh, Chief Financial Officer. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements, which may involve risk and uncertainties. Also, this is a reminder that this call is being recorded. I would now request the management to briefly explain us a bit about the business, detail us about the performance highlights for the quarter and for the year that went by, and the plans and visions for the business in the coming years, post which we can open the floor for Q&A. Over to you, Sukrit.
Firstly, a very good evening to all of you. Thank you so much for taking the time to be on the call today. This being the first call, I'll take a couple of minutes to brief you about the company. So VOEPL, Virtuoso Optoelectonics Ltd, is a relatively new company. We've been in existence only for about 8 years. The company was established in 2015. In 2015, we started with electronic components and sub-assemblies as the primary line. From there, we got the opportunity of manufacturing complete LED products. We did that. Then we got the opportunity of getting into manufacturing of indoor units for air conditioners. We did that. And now we are manufacturing complete air conditioners. We are fully backward integrated. And of course, we've come a long way since then. So that has been our journey. The endeavor and effort of the company is always to grow. We are, of course, currently very small. And I think there is a lot of potential as far as the Indian market goes, or the significance of manufacturing in the Indian scenario. I think there's a lot of potential and we have a long way to go. So we hope to contribute our bit, and we hope to continue building on manufacturing capabilities on our end. So that's where we are. As far as the overall introduction towards the last year's numbers and the performance last year. So last year we've grown revenue by 69%. We have grown EBITDA by 72%, and we have grown PAT by 97%. So the year overall has done better than our expected numbers by almost 10-15% in all aspects. Looking at the market reaction today, I understand there were certain concerns about number comparison between H1 and H2. But that was primarily because, the inventory value, the rates at which you buy inventory sort of rationalizes itself over the year, which is why H1, like we had mentioned before also in whichever investor meeting we had been part of, that H1 was abnormally good for us, which would rationalize over the year, which is what has happened. But the overall EBITDA this year is better than what we had anticipated. We were anticipating an EBITDA of 9-10%, but the EBITDA that we've got is about 10.3%. The other reason for pressure in H2 was because we've added the ODU manufacturing unit, which became operational only in the month of January end and February, and still is not running at peak capacities, because of which the added load of interest and expenses is what made the half looked a little skewed. But overall, year on year, I think this was a very important year because we've graduated from the definition of being an MSME, both in terms of top line and in terms of fixed investment. And I think we are laying foundation towards scaling up to be a much larger company over the next few years, with the support of course, all our investors, our customers, and our team. There's one more point that we've got a couple of questions, so I thought I'll address it, is on the acquisition of YLP. So YLP is an existing group company. It does about, last year it did about, I think 92 lakhs of top line. And so in terms of revenue in the entire year. So what it does is basically, if we get small projects or small retail custom orders from customers, we execute it via that company. We did not want to have a conflict of interest, and that is why we acquired majority stake in that company at a nominal cost of 3 lakh rupees, so that we could bring it under the umbrella of Virtuoso. So that was a brief from my side. I think we can open the floor for questions.
Sure. Thanks, Sukrit. Anyone who wishes to ask a question may use the option of raise hand. We've received some questions on the chat. Sukrit, I'll first put forward those to you. There's a
Sure.
question from Shikhar Mundra. What is our share with Voltas currently and how has that improved over the years?
So our share with Voltas, we'll have to break it down into IDU and ODU. So ODU we recently started, so I don't think share quoting a number makes sense. But in IDU, I think our share is almost 30% with Voltas.
Based on our revenue projection, we would be at 900 to 1000 crores. How much of this will come from ACs? How much from Voltas and how much from the rest over the next 3 to 4 years?
So the next year, the guideline, considering a 35 plus 40% growth, we are expecting a top line of about 550 crores next year and about 750 crores to 800 crores in the year after that. So that is the broad guideline. Now coming to the question of the breakup, so our current, out of the 800 crores, we expect Voltas to be about 500 crores, lighting business to be about 100, 150 crores, and there are a couple of components business to be about 50 to 80 crores, and there are a couple of other product verticals that we are launching this year to be another 150 crores.
His third question is, why is our interest cost so high, 14 crores on a debt of just 88 crores?
So the interest cost is higher because the invoice discounting component, which is off books, the interest of that also gets added in the entire interest cost.
There's a question from in the chat, and I would request all participants, please use the option of raise hand and you can ask the questions instead of putting it on chat. There's a question on chat from Mitesh Vora. When will the PLI benefits start accruing and any tentative deadlines?
So last year, our PLI incentive accrued, but not, accrued in the sense accrued in terms, in principally accrued is about 3 crores. But the claim filing application is still not open. So we'll probably file claim for that in the next month. And so in this quarter, we'll accrue the first 3 crore of PLI benefit.
There's a question from Vasu Gupta again in the chat. What is the in-house and bought-out components ratio for IDU and ODU manufacturing?
So backward integration that we've been able to achieve over the last 3 years for injection molding for IDU is we've got injection molding in-house. We have heat exchanger and the entire coil shop in-house. We have started cross-flow manufacturing in-house from February. We have sheet metal components which we have taken in-house from January. And so the only bought out components in ODU that we have now are motors and we are still buying some controllers and remotes from outside, but we've also developed them in-house. So the only component that we are really dependent from outside on making an IDU, at least the fixed speed version, is our motors. That's all.
There is another question in chat from Ayush Saraf. Guys, I would request you all to please use the option of raise hand and unmute and ask your questions. Ayush, would you like to unmute and put forward your question? The question that Ayush has put in is, what is the proportion of ODM versus pure manufacturing services stroke OEM? Is there a focus of the company to increase this percentage going forward?
So yes, so the lighting business is completely ODM. The AC business is majorly OEM for us, yes. But as we are investing more on components, we are being able to add more value towards design and contribution in terms of how we can add value. So we are developed. So our skills as an ODM are improving year on year as we are adding more and more backward integration. We are understanding the product better. Going forward, the new products that we plan to add will be completely ODM. So there we are developing ODM capabilities. In AC also we are developing ODM capabilities, but the requirement of these capabilities is not as significant because the customer that we are currently catering to, being Voltas, has these capabilities in-house themselves.
The next question is from Nabil Sayed. His first question is, why has the net profit margin reduced from 4% to 1%? when compared to H1 of FY23, which I think you already answered, but would you like to explain that again?
Correct. So, see, the pricing for us is done on a quarterly basis. So, in case the raw material that is expected in a specific period which is actually bought in the period before that. So we got unusual price benefit in the first half, which is why the profit ratio was more than our trend in the first half, which normalized over the second half. That was one. Second was second half, our pressure on expenses and salary was higher because of the addition of the ODU line, which was not running at full capacity because it got added only in the fourth quarter. So these two reasons combined, it seems that there was the pressure on profitability. But overall, the predicted profitability was between 1.5 and 2% for the year, which we have already, which we beat that number, and the overall profit I think is 2.3% for the last FY.
His second question is, are we planning to repay our debts? If yes, then by how much percentage?
Currently, we are not planning to repay debt. It's very important for all of us to understand that we are still very small compared to all, the 2-3 listed companies in the space. And the opportunity base, or against the opportunity base, I think there's a massive opportunity base. And if we have to make any mark for the next 3, 4, 5, 10 years, however, as long as we have opportunity, I think we should really make use of the opportunity and grow and scale the business. So the idea is to, of course, give preference to growth and not debt repayment.
We'll take the next question from the line of Shikhar Mundra. Shikhar, you can unmute and ask your question.
Just a follow-up for my previous question, which I asked. For the interest cost of 14 crore, what is the breakup between the actual interest paid and the invoicing component?
I don't have the number with me, but I believe we have on an average about 5 crores out of the 14 crores. 4 to 5 crores would be of the invoice discounting, and rest would be for the working capital and terminals.
All right, got it. Thank you.
We'll take the next question from Monik. Monik Shah, you can unmute and ask your question.
Hi, I just wanted to know the current this capacity utilization. Okay, what is right now, and is there any scope of increasing the margin, since we are a lot of backward integration is happening? So if you can brief on that two segments, it will be great.
Sure. Capacity utilization, as far as the IDU is concerned, during the season we were at peak capacity for IDU. And margin improvement, I believe, has already. So, I mean, margin improvement product wise is a cycle. So, in IDU, I think we did a better margin than anticipated, and that is why the overall margin for the year has improved. But at the same time, ODU is a newer product category for us, where we'll still take time to optimize the margin levels. So, I think that is a cyclic thing. Also, that being one factor. Second factor is ODU has a lesser value addition component, because compressor and the controller board both put together contribute almost about 45% of the cost. So the value addition component is lower, and hence the EBITDA level margins are lower in ODU. This year, if in our top line, almost we are anticipating about 200 crores to come from ODU business, which will further put stress on our overall EBITDA margins. But the average EBITDA margin that I think we can maintain is about 9 to 10%.
Thank you so much. Yeah.
Thank you.
Thanks, Monik. We'll take the next question from Mitesh. From Neerav Vasa. Neerav, you can go ahead.
Okay, would it be possible for you to share the kind of volume growth that has happened in the month of April and May of this year, considering there was massive unseasonal rainfall? How has been the offtake in Q1 FY24 happened with your key customers in air conditioners?
So our numbers from January to May have been constant in terms of top line. So we have still not had any impact on sales numbers. For the next month of June also, we don't see a significant impact. I think this year first quarter will be a very good quarter for us, because we are still running at 100% IDU utilization capacities.
With regards to lighting, most of the names which are there in most of the brands in the lighting segment are I would say, not in the best of the shape. According to your assessment, by what time are you expecting markets to revive and pricing action to happen and overall growth can come in the lighting part?
So our strategy in terms has been very clear. So almost 70% of our business this year came from Panasonic as a primary customer. The reason for that is Panasonic is a very structured customer and they have a set pattern and they do business in a very methodical manner. So there we don't get impacted by the market directly. So as far as we are concerned, we've been isolated from any fluctuations in the market. Of course, I think the larger players, there has been a shuffle where Cisco came in, became strong, and then Cisco is struggling now. So there has been a struggle, but I think all this will settle down. As far as our business is concerned, we are very selective in terms of working with lighting customers because this we understand. So we understood it very early in the first 3-4 years of our, from 2015 to 2018, when we were dealing with smaller players in lighting, we understood that if we rely heavily on tier 2, tier 3 brands, the fluctuations are much higher. So for us, the predictability becomes lower and we cannot make a business model out of it. So what we started doing then was we started focusing on fewer customers and customers who are consistent in terms of their projections, volumes and margins for us, because that is where we are, and we are not really looking to abnormally grow or abnormally degrow, both in revenue or margins.
With Panasonic being the anchor customer, do you think our exports, Panasonic, we can ride on exports using Panasonic as a brand? Or
so we are already exporting via Panasonic to Nepal and Sri Lanka. We are also recently in talks with somebody in the US for exporting some of our lighting products to the US. We had last year got the UL certification, but because of COVID, things had gone on hold again. This year we have reinitiated talks. So yes, lighting, we are hoping that we can get some export business coming in the next 1-2 years, but of course the quantum will not be very high.
thank you, sir.
Thank you.
Thanks, Neera. We'll take the next question from Mitesh Vora. Mitesh, you can unmute and ask your question. We'll move ahead to Samir. Samir, you can unmute and ask your questions.
Yeah, hi, am I audible?
Yes, you're audible.
Yeah, hi, Sukrit. Just you mentioned a sales turnover target in the next 2 years of about 750 crores. But also some reduction in margins, given that ODU is a slightly lower EBITDA margin product. Is that correct? So 9.5-10% overall company margin?
9 to 10% EBITDA margin, yes.
Sorry, can you repeat that?
9 to 10% EBITDA margin, yes, that's correct.
So with the doubling of scale, there is no operating leverage flowing through where you can possibly make a slightly higher EBITDA margin than where you are today.
So if you see the product mix, we even if, I mean, for IDUs, let's say our operating margins are between 10 and 12%. We were able to optimize it from 8 to 10% to 10 to 12%. But with ODU coming in, the operating margins in ODU are only 6 to 8%. So that is why the average does go down. We'll have to keep optimizing, but looking at the industry trends and I mean, our peers or much larger players in the segment are working at EBITDA of maybe 5%, 4% or 6%. So we are, I think, still better. I don't think making it further, improving EBITDA further is possible at this stage. Of course, we can optimize in terms of our interest costs and depreciation and improve PAT. But then if we want to continue growing, which we intend to do for the next 3 to 5 years, and if we continue investing, then those two components will continue to be heavy.
So what would be the flow through below EBITDA line over the next 2 years? The PAT margins will continue to remain in the 2-2.5% range?
Correct. They will, yes. Like I said, we want to not, so we are on a very small base right now in terms of investment and in terms of turnover. And if we want to stay competitive in the industry, we cannot lose space with our competitors and fall too far behind. And there are a lot of products and a lot of segments that we have to explore, or we are exploring, and we are getting a lot of inquiries from. So if we are able to capitalize one at a time and then keep growing, then I think the incremental investment will of course be required. Every investment that we do will take 1 or 2 years to sort of mature, and for that 1 or 2 years is going to put pressure on the existing business.
So basically, at 750 crore turnover as well, we should expect sort of an inline growth in profitability, 2.5% PAT margin, given that you're investing and you're looking for growth and all of that. Is that right?
That's correct, yes.
Okay. Thank you so, and all the best.
Thank you, sir.
Thanks, Samir. Mitesh, you can go ahead and ask your question.
Yeah, hi. Am I audible?
Yes, you're audible.
Yeah, just wanted to ask with respect to the increase in turnover for the next 2 years, and with the economies of scale, with the increased volume coming in,
right?
Do you expect the margins to improve in the next 2 years? Because with respect to overheads and all, and with any increase in raw material, if we are able to offset that with the increase in volumes, yeah.
So, I mean, of course, we always strive for that, and that is the intention with what we work. But the practical challenges are that even if we improve our EBITDA margins with all these, there also might be pressure from the customer. There also might be volatility on the raw material side, which might impact us by 1%. So, I mean, a 9 to 10% guidance, I think, is a good guidance in terms of EBITDA, because we will strive to beat it always, like we did last year. But saying that we will definitely be able to do it is difficult.
Okay. And with respect to other than Panasonic, any other larger or bigger customer likely to be in, at least in, who might have just visited your site or some vendor assessment, something like that?
We are talking to 2-3 other customers also, one being a larger one.
Okay, because recently in news also several large customers, something like a Walmart or something, are looking on for vendors in India. So something on that scale?
Not on that scale yet, but we will definitely explore that also.
Okay, thank you.
Thank you.
We'll take the next question from Bhumika Nair. She's unable to use the option of raise hand. Bhumika, you can unmute and ask your question.
Yeah, hi, thanks. I wanted to first understand what is our current ODU and IDU capacity, and what are our plans for expansion, given that we're looking at almost 750 crore of revenue next year. So from that perspective, just wanted to get a sense on capacities and expansion that we are looking at.
Right. So our current investment is sufficient to achieve next year's top line. So we are already on a 60 crore run rate as far as these last 4 or 5 months is concerned.
Sorry, 60 crores.
Correct. We are so the IDU capacity that we have currently is about 6 lakh units, and we plan to expand this to 8 lakh units by end of this year. The ODU capacity that we currently have is 2.5 lakhs, and we want to expand this to 4 lakhs by end of this year.
Okay. And you know, from a backward integration perspective, you said we started off with CFF and other kind of components, heat exchangers, etc. So we would be completely 100% backward integrated into all these components, or is there, just a part bit that we are able to do, or entirely there is 100% backward integration?
So, for example, let's say heat exchangers, we started with zero integration. Now we are 100% integrated. With injection molding was similar. We started at 0. We are now almost at 90% of in-house backward integration. So similarly, every product we are at different percentages, but these percentages will over the next year grow for us to be 80% on an average, 80 to 90% on every component to be backward integrated in-house.
Okay, got it. In FY23, what would have been our volumes for IDU and ODU that we would have sold out of this capacity?
IDU, we've almost sold about 4.5 lakhs last year.
Okay.
Because our capacity grew towards the end of the year, and that is why we peaked numbers from December to March, which was also part of the season. And ODUs we only started in January, so we did about 28,000, I believe, 1,000 ODUs in the 2 months, February and March.
Okay. So basically, a lot of the growth will really come out not only of IDU kind of seeing expansion, but also from the ODU ramp up in the capacity. Okay.
Correct.
And your currently our key customer is Voltas. What is what is it that they're talking about in terms of growth, and what is the thought process of adding more customers for the AC segment?
So for us, the thought process is very clear. One is, of course, in ACs right now, Voltas has not told us to. Voltas is buying whatever we've been able to make. So we don't want to add another customer while not satisfying their expectation as far as AC is concerned. So there, we are first trying to meet their expectations. One, we are satisfied that when we completely satisfy their requirements, then we can look at other customers. We do have some inquiries, but we'll only go after them seriously after we can satisfy Voltas, because they have helped us sort of grow in the AC industry. We want to give them that priority. So, and of course, we are learning from them. We get a lot of support from them. So that is why we want to continue doing that. That is part one. Part two is we are also not just in AC, but we are also adding a couple of products this year, at least 2, if not 3. So there are different product categories now. So with these product categories, we will get, of course, our existing customers are most welcome, but we are also talking to other customers to sell these additional categories. So we will diversify not just in terms of customers, but we'll also diversify in terms of products by end of this financial year.
And these product categories would be lighting and which else?
So lighting and AC, of course, is the existing category.
Right.
We are adding 2 more categories. Once we have signed with our customers, we'll share it with you. We right now don't want to share the details. Because of confidentiality.
Okay. And while obviously, as you mentioned, Voltas is something which is very large for us and we're trying to satisfy them. But would it be fair to say that we should kind of start seeing new client additions in the AC segment from 25 onwards? Because, by next year, if we double our volumes, etc., I'm sure there would be a scope to kind of add more clients into FY25.
That discussion, I think we want to openly have with Voltas before we do anything. So I think we want to give them first benefit. If benefit, or we should first talk to them, they being our primary customer. If they, of course, they don't need more volumes from us, then we can look at other customers.
Sure. And just last question, if I can just squeeze in terms of the capex for FY24 and 25 from all the segments, including the new segments, product categories that you are planning to get into, what would be the broad capex number?
So we are expecting a capex of almost 60 crores in this FY.
Okay, got it. Thank you very much and wish you all the best, sir.
Thank you so much. Thank you.
We'll move ahead to Shrikant Bandaru. You can unmute and ask your question.
Yeah, hi Sukrit. Thanks. Firstly, congratulations to you and your team on very good performance this year. And I hope this continues over the next few years. I have 2 questions. One is on the market size. Where do you see the company going to in, let's say, 5 or 6 years? I know you've given some kind of a guidance for the next 2-3 years, but how large do you see the company getting to in, let's say, 5 to 10 years? And the second is on cash flows. What are your thoughts on your operating cash flows going forward? Do you see them getting positive? And at what stage do you see free cash flows going positive as well? Thank you.
So the first part of your question being, how do we see what is the potential size? So, manufacturing so if you take a small step back from the entire situation and Virtuoso as a company, the current India as a market does not have, there are not enough manufacturing companies for any large product category. As far as the finished product is concerned, you take any product in the segment and you will find that there are only 2, 3.
Focus on him. He's asking for CD and all.
There are only 3 or 4 OEMs that are active in any particular product segment, which when compared to a country like China would be a 10-time or maybe a 20-time number, where there might be 70, 80 people who are active in that industry. So as an industry, as a country growing in the manufacturing segment, we are not even scratching the surface. We need multiple large companies in India in manufacturing space to come close to the capability of what probably our country is envisaging as far as manufacturing is concerned. So the bottlenecks that we see are for the growth of the company are a combination of financial resources, team, and our ability to manage the operations. I don't think market or prospective customers or localization challenges should be the real growth inhibitors. So, I mean, to answer your question now shortly, I don't think there is a limit to how much we can grow. The limit will come based on a combination of these 3 factors. Giving a longer term guideline indicative number is very difficult, but for the next 3 years, we're looking at a 30 to 40 or maybe a conservative side of 30 to 40% CAGR. So that was the first part. The second part, operating cash flows. As the operating cash flows, the pressure, the operating cash flows will continue to be under pressure as long as we keep increasing our turnover, because we will need more and more inventory. The beginning of the year, when we started the year, we were at a run rate of maybe 20-25 crores a month. And when we ended the year at a run rate of 60 crores a month. So our inventory went up in a similar fashion, because we almost need to have a 45-day to a 60-day inventory. So as and when, if till we don't stop growing, I don't think cash flows can become positive, because they will continuously keep requiring more money to sort of scale. I hope that answers the question.
Yeah, it does. Do you have any thoughts on your ideal return on capital employed? Do you have any thoughts on capital allocation and the kind of returns you want on that?
So we are ideally targeting at least 6 times on our capital employed, but 5 being the minimum.
Okay. Thank you so much, Sukrit. Thanks.
Thanks.
Thanks, Shikhar. Shikhar, you may unmute and ask your questions.
Yeah, so as you said, our current share in IDU is 30% with Voltas. So what was this a few years back, let's say 4-5 years back, and what has enabled us to gain this market share?
So 4-5 years back, we were not in AC at all. We started AC business with Voltas in 1920. That was the first year of operations, and the numbers were hardly anything. So we were at almost 0% in 1920. And this has steadily grown to 30% over the 3 years. I think the year before this, we would have been at about 14-15%.
And who are these players from which we are gaining market share? Like, who are the other players?
I will not be able to comment on that. I don't know where Voltas is exactly buying from. A lot of it was import, that I know for sure. But so the import has been substituted, yes. But within India, I don't know if you've taken anybody's share or we've just majorly taken the import share.
All right, got it. And is the realization of IDU and ODU roughly the same, or is there a difference in realizations?
You're talking about EBITDA?
I mean the revenues and the EBITDA. EBITDA, I understand ODUs is slightly lesser. What about the realizations on the top line?
As far as our capacity is concerned, our capacity for ODU is lower than IDU, much lower than IDU. Okay. But the value, so if we make 2 lakh ODUs, the value is equivalent to 4 lakh IDUs.
Okay, got it. And one last question: out of the 337 crore we did this year, how much was it from the lighting segment?
About 70 crores, I believe.
Okay, and in units, how much would that translate to? Number of.
So it's a mix of a lot of products, but I think that would be about 2 crore LED lamps, I think. If I'm right, 2 crores is the average cost of 30 rupees. Yes, about 2 crore LED lamps.
And what is our capacity for the LED lamps?
Blended capacity, I think we can do almost 3.5 crores.
All right. Got it. Thank you.
Thanks, Shikhar. We'll take the next question from the line of Aditya Shah. Aditya,
Hello.
you can unmute. Yeah.
Yeah, sorry. Just one question. Most of my other questions have been answered. This 750 crore top line we are targeting in 2 years, is it consisting only of ODU, IDU, and lighting, or does that also include the 2 potential new products that we are targeting?
Conservatively, the 2 potential products that we are adding. Yes.
Okay, and any rough split we would have of, let's say, from the 750, how much would be the AC and the lighting?
So AC and lighting would be about 600 crores, 600 plus minus 30-40 crores.
Okay, and the main growth that we're seeing going forward from today's, let's say, around 260 crore of ACs, the main and taking us to the 600 crore, the main growth will be coming from AC, or we think that this 600 crore will be split in similar as it is today?
Similar split. I mean, barring AC currently is about 70-75%. I mean, full AC is about 70-75. Components will be about 5-7%. But if you see AC as a full category, I think AC will go down to about 50-55%. Lighting will be about 15%, and the rest could be the newer categories.
Okay, understood. And is there any difference in components, margin versus ODU, IDU, or is it all similar range?
Components, the asset turn is lower, but margins are better. On the product, the asset turn is much better, but margins are lower.
Okay, understood. Thank you, sir.
Thank you.
Thanks, Aditya. We'll take the next question from Vasu Gupta. Vasu, you can go ahead.
Yeah, you have said your requirement is 60 crores for capex for FY24. Just wanted to know how you are going to fund it, and I think it is for the expansion for IDU and ODU and CFF. When will it come online?
The investment is both for the newer categories that we are talking about and expansion of IDU, ODU, like you mentioned. So this will come online in phases. So the first phase will be online by second quarter, and the second phase will be online by the fourth quarter. So, but of course, we have already started incurring the capex required for this. Most of it is right now planned by debt. If we do get a good opportunity, we will look at raising funds, but primarily we have already tied up for this investment by debt.
Okay. Also, are we seeing any export opportunity from Voltas?
We are already exporting a lot of products for manufacturing products for Voltas, which are being exported to Middle East. For the last 2 months, we've been exporting a lot of products.
Okay, thank you. That's it from us.
Thanks, Vasu. We'll take the next question from Varun Agarwal. Varun, you can unmute and ask your questions.
Thank you for the opportunity. As you said that the cash flows will remain under pressure. So how do we fund the growth going forward?
So debt is our easier go-to method for funding. It's cheaper for us at our size and valuation. So debt is, of course, primary funding will come from debt. And like I said, if we get a good opportunity, we will be open towards equity, but maybe not in the next 2-3 months at least.
So in terms of debt, do we have any internal understanding that this will be the maximum debt we will raise, or any debt equity ratio which we want to maintain as a ceiling?
So the debt equity ratio that we want to maintain is about, this year, because we raised the capital, our debt equity is gone below 1.
Yeah.
Which is which I think is very healthy. But I think having a guideline of, the range of 1.5 to 1.75 is I think a decent enough number for us at this stage.
And if there is a equity funding in the future, will promoters also participate in that?
As of now, we've not decided anything, but let's see.
Okay. No, I'm asking because the promoter stake will get diluted if you don't participate. So from that angle, yeah.
Correct. I agree.
Okay, thank you.
That is why we are also being conservative, because we've already, we are at 65% as promoter holding. So
yeah,
right.
Thank you for the opportunity and all the best for the coming quarters.
Thank you.
Thanks, Varun. Anybody else who wishes to ask a question may use the option of raise hand, or you may unmute and ask your questions. Aditya, you can go ahead.
Thank you. Sir, wanted to ask, why is Voltas, going ahead with working with us versus working with, like, what is making Voltas want to work so much with us versus who they had earlier? That's number one. And number two is, with a lot of these contract manufacturers now coming up, what is protecting us from, Voltas going to somebody else?
So, two parts to your question. One is, see, right now we are manufacturing, so our factory is manufacturing only for Voltas. The factory is almost dedicated to Voltas. So it gives them more autonomy in terms of how they want to operate the factory, which I think is one of the factors that work in our favor. Point number one. Point number two, AC is not a product which you can, if you're manufacturing an AC where tools have been supplied by Voltas to us. So the IDEO tools have been supplied by Voltas. So it is not something that you can just pick up and move to a new location, start manufacturing. It is almost a 6 to 9 month process to be able to do that and settle the entire line. So that gives a certain stickiness for them to operate with one vendor. Otherwise, it is a loss on the productivity of the tool for Voltas, and also it is a loss of production capacities. So that is why that gives us the confidence that we will continue getting business from Voltas. That is one reason. As far as if we are getting any preference or not, I think we entered IDEO at a time where it was getting replaced, import was getting substituted. And to substitute this import, we sort of entered at the right time. We got entry at the right time, and I think that sort of opportunity we were able to capitalize during the last 3 years. Hence, we are enjoying whatever share we are. I don't think we have actually sort of taken any share from the Indian manufacturers. Maybe a little bit, but not too much.
Understood. But sir, today, we have a lot of larger players as competition, who we are, of course, growing faster than. But what is preventing them from, setting up a dedicated factory, for any of these guys to just avoid losing that domestic market share?
Theoretically, there isn't. Theoretically, a larger company can set up a factory very quickly for every customer. But like I said, it is a combination of them getting comfort. One, very difficult to understand why they get comfort in place A over place B. Second is because we started early, we were one of the first people who they trusted with their tooling. So I think we've been a little ahead in that race. Both factors combined. Third, of course, I think price-wise, I believe we are competitive, at least if not better. So which gives them no reason to move away. So price, service, and I think a little bit of timing as a combination has put us in this position.
Understood. And sir, you mentioned the lighting. You had approximately 2 CR LED lamps you made in the last year. The capacity of 3.5 that you mentioned, would that translate approximately evenly? Like if you did 70 crore, let's say from 2.
So the thing is, we are doing regular LED bulbs, which is the cheapest, the lowest value product. Then we are also doing emergency-based lighting, which is the battery backup lamps that are there. So that series also we are doing. We are also doing panel lighting, which goes as downlighters. We are also doing street lighting. So we are doing the entire range. So one street light would be making one street light is equivalent to almost making 20-25 lamps. So we are currently giving you capacity in terms of lamp equivalents, but it is very difficult to sort of quantify the capacity where you have so much product mix.
Okay, so this potential 3.5 crore capacity, is there a range of revenue we can hit, or is it very difficult?
Yes, so we are. We are looking at growing in lighting also at 30-35% at least year on year. But capacity wise, I believe we can almost do 120, 130. And if we get the right product mix, anywhere between 100 and 150 crores, depending on the product mix and specific machine utilizations.
Okay, and how long would it take you to set up further capacity in AC as well as lighting? Is it a 6-9 month process?
So the capacity expansion for us is twofold. One is expanding capacities incrementally in the existing facility. That is something that we are doing on a regular basis, and adding a new facility to expand capacity. So this year we plan to add 2 facilities. One being a larger facility, and the other one is a smaller facility where we are doing some component backward integration. But the larger facility will be required for the additional growth in the new products that we plan to do.
Okay, and how long does it take for these to come online, existing facility versus new facility?
So existing will come online by second quarter, and the new facility will come online by fourth quarter.
Okay. Okay, fair enough. Thank you, sir.
Thank you so much.
We'll take the next question from Pankaj. Pankaj, you can go ahead and ask questions.
Hi, sir. This is Pankaj here. My simple question to you: how much percentage of raw material you are importing from outside of India, and is there any plan to develop, backward integration further for your all upcoming products as well as ongoing products?
So in IDUs, the only major components that we import are copper, aluminum, and motors. Copper and aluminum, still there is no supplier in India, where two, three companies do plan to set up this facility, but none of these facilities are up and running. So in the next 1 or 2 years, I don't see copper and aluminum being sourced locally. Motors, yes, there are companies setting up motors locally. There is some production of motors locally. So motors is now mixed of local and import. But copper and aluminum will continue to be imported for the next 1 or 2 years at least.
Thank you.
Thank you.
Anybody else who wishes to ask a question?
Yeah, hi, this is Srinidhi. Can I ask?
Yeah, go ahead.
Yeah. So, Sukrit, you alluded that your margins are superior to some of your listed peers despite being a lower scale. In your assessment, what is really driving this superior margin despite weaker scale?
So right now our overheads are much lower than theirs, I believe. That is one reason. That is why we are better at EBITDA levels, but PAT levels we are similar or maybe lower. So our overheads are lower. That is the primary reason. And I think we've been able to keep our investment base smaller than them. That being the second reason. The second part to the second reason is that our capacity utilization as far as the equipment is concerned is currently, I believe, better than a lot of our competition. That is what is giving us an edge of about 1 or 2%.
And we also got to learn that Maharashtra state offers a lot of incentives for MSMEs putting up new plants in the state of Maharashtra. So wondering, is that a substantial benefit that Virtuoso enjoys?
So we have one sanction for that, but we are expecting a couple of more sanctions this year under the electronic policy of Maharashtra. So over the next 3 years, we do anticipate subsidies of, so this year we are anticipating subsidies of 8 to 10 crores. And this figure should go up to about 25 crores in the next 3 years.
Right. And is
All
there
put together, Maharashtra and PLI put together.
Okay. And is there a GST reimbursement also in the state of Maharashtra for putting up plants, particularly in the backward areas of Maharashtra?
No, so the subsidy is in the, I mean, it is not GST reimbursement in a manner of speaking. So the subsidy is against your GST paid to the state.
Right. And that we
So
quantified being 8 to 10 crore this year, going up to 25.
Correct. This is including PLI and state electronics incentive.
Right. And do you get to retain large part of it, or you need to share it with your anchor customer Voltas?
I believe we should consider that we'll have to share it. Okay. I mean, sharing is a more realistic consideration to have.
Well, thank you for answering my question and all the best.
Thank you so much.
Thanks, Srinath. I think there's a follow-up question from Aditya.
Yeah, just one small bookkeeping question. In this current EBITDA margins and PAT that you've reported, there's no PLI and government, state government subsidy, correct?
So there is no PLI benefit. PLI will start coming in from this year. State government, this year, over the year, we have accrued about 2.6, I believe. 2.6 year of incentive, but we have that has been taken care of in these numbers.
Okay, got it.
6 crores has been accounted for these numbers, yes.
Understood, sir. Thank you.
Thank you. We'll take the next question from Sagar.
Hi, so just a couple of questions actually. So first one is, you mentioned that you are already on a run rate of 60 crores per month. So does that mean that, next year itself we are going to achieve the 750 crore kind of revenue? Is that the right understanding?
We hope to, but the reality is that normally second quarter and third quarter is not as good for the AC industry in general. So the sales numbers do drop in the second and third quarter.
So there's a seasonality in the business.
Correct.
And the second question is, you in the deck you mentioned about you manufacturing BLDC motors. So is that only for in-house consumption, or do you plan to manufacture it, to sell it to third party as well?
So initially we are exploring only for captive consumption. If we are able to successfully validate it, then of course we can scale it. But first we are trying to work out prototypes and see if we can manage our captive requirements.
And like there is some regulation around using it in fans. Do you have that regulation in AC also? So yeah, I'm not very well aware about this market.
So AC, there are BE and BIS regulations already, and we are complying with all those regulations. Fan, of course, is now fan. The regulation has been introduced recently. AC has been having this regulation for a couple of years now.
Got it. Thank you, and best of luck.
Thank you, sir.
Thanks, Sagar. I believe that is the last question for the day. Sukrit, would you like to give some closing comments?
First of all, thank you so much for all your faith in VOEPL. I think investor confidence, customer confidence, and employee confidence is what is very important and vital for the growth of the company. We will continue to strive and do our best in terms of contributing toward the manufacturing vision of the country. And once again, thank you for attending. A very good evening to all of you.
Thank you so much. Thanks to all the participants for joining on this call, and thanks to the management for giving us their time. That brings us to the end of today's conference call. Thank you.
Thank you.